Hi, and welcome to your Canon Trading Market Resource Center. I'm John Thorpe. Today I have a quick presentation to give the listener a brief overview of the topics affecting futures trading. This video will touch on hedging your crop in the futures market. One of the primary functions of the agricultural futures and options markets, and is the foundational reason for this industry, is hedging. Hedging is the management of the price risks inherent in the purchase or sale of cash positions and offset with futures contracts for commodities and financial futures contracts. A reduction in risk results in an increased certainty in outcome. Hedging is designed to protect anticipated profit margin and reduce potential loss. In hedging, price risk is transferred from those seeking to reduce risk to others who are willing to assume that risk in hopes of making a profit. We will refer to the participants as hedgers or commercials and specs or speculators. As a general hedging rule of thumb to determine whether to buy or sell futures, I follow this. If your future action includes selling in the cash market, an appropriate hedge today is selling futures. If your future action includes buying in the cash market, an appropriate hedge today is buying futures. Gains and losses in the cash market will be counterbalanced by gains and losses in the futures market, as they tend to move up and down together. So the farmer whose crop is still growing in the field has a long cash position and will be willing to sell in the future. When he wants to hedge and lock in a selling price, he will take a short futures position by selling contracts now through his broker. For livestock feeders, grain importers, food processors, ethanol distillers, and others who need to acquire the grain at a later date in the future, buying the cash product in the future, they have a short cash position currently and would lock in a purchase price now by calling their broker and taking a long position in the futures market. Lifting a hedge is to concurrently close out an existing hedge position and a related futures contract as the corresponding physical commodity is bought or sold in the physical market. Simply put, if a hedge position is being maintained when physical cash grain is bought, corresponding futures are sold to flatten or lift the hedge, and when physical cash grain is sold, corresponding futures are bought back. Then there's basis. Basis is the relationship between the local physical cash price and the underlying futures price. The price difference between the cash and futures may be small or it may be large, and the two prices will not always vary by exactly the same amount. This price difference represents variables as type, class, quality, location, transportation, and freight costs, storage and handling, as well as local supply and demand factors. As a buyer or seller of grain, you know the physical cash price for grain in your local area will differ from the price quoted in the reference futures market. Basis simply is the difference at any given point in time between the cash price for a commodity delivered at a particular price and time and the reference futures price for any given contract month for the same commodity. For anyone buying or selling grain, there are three factors, that ultimately determine the final price of the commodity: the futures price, the local basis value, and the applicable foreign exchange rate. Futures hedging can help establish price either before or after harvest, even during. By establishing a price, a producer protects against price declines, but also generally eliminates any potential gain if prices rise, locking in production target prices. Contact a Canon professional to walk you through a simple account establishment to set up your next hedge and help control the outcome of your marketing year. The next video will talk about how to determine the amount to hedge. Make it a great day.